Hello and welcome to our webinar today covering issues and updates to the international provisions of the Tax Cuts and Jobs Act. My name is Vaughn Lawrence. I'm the Director of Communications and Technology for PAMIC. As an organization, PAMIC is focused on providing timely education to our members about the issues that directly affect their companies. Today we're focused on international provisions to the Tax Cuts and Jobs Act, and we have three expert presenters from Mazars. We're excited to have them today, and I'm excited to be here and learn more about some of these international provisions. Before I begin, I want to take a second here to thank our Premium Gold sponsors for 2018. Their company sponsorships give us the opportunity to offer high-quality education and exclusive benefits to our membership throughout the year. Their support is crucial to the success of our organization, and we really appreciate all the things they do for us. And those sponsors are Baker Tilly, Donegal, Gen Re, Guy Carpenter, Markham, Munich Re Hartford Steam Boiler, Mutual Boiler Re, Pennsylvania Lumbermans, Swiss Re, and Willis Re. On the topic of education today, we are going to be having our annual 111th Mid-Atlantic Mutual Advantage Convention coming up in August. That's going to be August 5th through 7th, and it's going to bring together mutual industry members from the associations in Maryland, Pennsylvania, Virginia, and West Virginia. So we hope to see you guys out there for that event as well. Now I'd like to introduce our presenters for today. First, we have Stephen Green. He has more than 25 years of federal and foreign insurance tax experience, including property and casualty, life, health, mortgage, financial guarantee, Blue Cross, Blue Shield, and title insurance. Steve joined Mazars from Ernst & Young's Financial Services Office Insurance tax practice, where he was a senior manager responsible for reviewing statutory and GAAP income tax provisions of public and non-public clients as part of a financial statement audits, including footnote disclosures, implementation of SSAP 101 requirements, and validation of deferred tax balances. Next, we have Tiffany White King, and she's the International Tax Services Leader for Mazars. She has nearly 20 years of tax experience providing operational, strategic, and marketplace direction for emerging, mid-market, and large multinational companies. Her experience includes international tax structuring, transaction planning, mergers and acquisitions, tax revision, compliance reporting, and other related services. And last but certainly not least, we have Jay Wang, and he's a senior tax manager with Mazars. He has over 12 years of extensive insurance, financial services, and accounting experiences. Jay focuses practices in the areas of GAAP and statutory income tax provisions, tax compliance, and tax consulting for public and non-public clients. Today's webinar, all the materials, including the slides and the video presentation, will be available on our website tomorrow afternoon. So you'll also receive an email with all that information in there. You'll also notice that there's a Q&A button at the bottom of your screen. Please feel free to use that throughout the presentation if you have any questions to ask the presenter, and they'll make sure to get to those as soon as possible. And with that, I'm going to hand it over to Steve, and we're going to begin the presentation.
All right, thank you, Vaughn, for that introduction. I appreciate it. Welcome everybody on the phone. Today we're going to be talking about the international tax provisions of the Tax Cuts and Jobs Act that was enacted December 22nd, 2017. And what we're going to be doing is today's agenda is going to talk about that due to the Tax Reform Act creating new international tax rules, we will be discussing the different international tax provisions that exist now that resulted in creating different international tax systems for the U.S. More specifically, we will be discussing the Section 965 Repatriation Tax, sometimes referred to as a toll charge tax, the participation exemption, the global intangible low taxed income or GILTI provisions. We'll also be touching on the base erosion and anti-abuse tax or BEAT tax. That's well known in the industry. And we'll be talking about other new, repealed, and revised international tax provisions such as the PFIC rules. And at the end, hopefully we'll have time for additional questions that we may not have been able to address for you. But during, like Vaughn said, during the presentation, if you have any questions, feel free to use the Q&A button. So with that said, let's see. So we're going to get right into the tax systems here. And I'm going to hand it over to Tiffany.
Great. Thanks so much, Steve. With the Tax Cuts and Jobs Act, or the TCJA, there was a lot of pressure for the U.S. to really be a competitive player in the tax game. For many years, the U.S. was really in the minority, subscribing to the worldwide taxation system. Essentially, this means that here in the U.S., a taxpayer, meaning a citizen or resident, is taxed on their global income regardless of where it's earned in the world. Now, I think one could very well escape the double taxation, obviously through the intervention of treaty relief with our various treaty country partners, either through our foreign tax credit or deduction mechanisms. However, with the advent of the TCJA, the U.S. really needed to become more competitive and attractive vis-a-vis its foreign counterparts. So here comes this concept of the territorial taxation system, which virtually every country globally subscribes to. This means that citizens or residents are taxed on their local source in-country income only, as opposed to global or worldwide. So if income is earned in one country, then it's taxed in that country. But query, did we really achieve a territorial taxation system with TCJA? And the answer, as we probably all know, is not exactly. So as you've likely been reading or hearing in the news or media, especially with the overlay of the international provisions, which we'll get into a little more detail later, we've become more of this quasi or hybrid territorial system, if you will. And certainly the international tax reform provisions add more complexity to our U.S. tax system. They did before, but arguably now more so than ever. Steve and Jay, would you agree with that?
Oh, yeah, absolutely. Yeah, the international tax provisions, are really seen as really a bolt-on provisions to the old provisions that are still in force. So a lot of the old global or worldwide tax rules are still in force. And so one of the biggest challenges that we have as tax people is to really understand the intersection of the old and the new provisions. And that really results in not only the complexity of the new provisions, but also the complex interactions between the old and the new provisions. Jay?
Yeah, I mean, this new tax act, including a significant overhaul of the international tax rule, that will impact the global operation of many multinational insurance companies and the groups. And also this new international tax rule fundamentally changed the U.S. approach to the taxation of foreign earnings, including implementation of this territorial system, or whatever the quasi or partial territorial system in some extent, as Tiffany pointed out. There's some mechanism by providing 100% of DRD on certain qualified dividend from foreign subs, and also domestic corporation will continue to apply existing Subpart F rules. That is, like Steve pointed out, this old rule voted with this new rule.
So now we'll turn to our section 965.
Yep. Okay. There we go.
And here, in order to move to this quasi or hybrid territorial system that we just described, the U.S. opted to really employ a transition rule or transition tax, or also known as the toll charge. But in other words, knowing that there's this large pile of untaxed earnings that are offshore, we needed to find some incentive to tax those earnings and hopefully bring them back on shore for reinvestment into the U.S. economy and business. So maybe to spur more growth, increase job employment, enhance take-home pay. But let this thought sit with you for a moment. Just really ask yourself, did we really achieve this with the Section 965 repatriation tax? I'll come back and I'll ask that question again, but let's just focus on this transition rule. Essentially, the Section 965 tax seeks to tax offshore earnings of what's known as a specified foreign corporation or an SFC at reduced rates. This is almost akin to what we know of as a tax holiday. And the reduced rate for offshore E&P is 15.5% to the extent that it relates to cash, and it's 8% to the extent it relates to non-cash. So how do you know if it relates to cash versus non-cash? Well, you compare the E&P to the company's balance sheet. So let's just take a simple example. Let's just say you have $100 of earnings, and the balance sheet for the specified foreign corporation or the SFC in question, it shows $150 of cash and $200 of non-cash. So again, $100 of earnings, $150 of cash, $200 of non-cash. Since there's more than ample cash to absorb the E&P, the full $100 of E&P would be attributable to cash or subject to the 15.5% tax rate. Now instead, assume those same facts, but change only the cash amount on the balance sheet. And let's just say still $100 of earnings, but now cash is $75. So in this case, $75 of the 100 of E&P would be attributable to the cash, and then the remaining 25 would go to non-cash. And obviously the non-cash is taxed at the lower 8% rate. Here, with our Section 965, the tax is imposed on all U.S. shareholders. So it's not limited to just corporate shareholders, let's say. It applies to individuals, and it applies to holders of pass-through entities. SFCs, or specified foreign corporations, include controlled foreign corporations, or you may know them as CFCs, but they also include other foreign corporations for which U.S. shareholders at least own a 10% interest. So it's not just CFCs, but it's other significant holdings of foreign corporations as well. And that significant holding is at least a 10% interest. Also important here is that deficits of the SFCs may be allocated under the Section 965 statute to offset any positive earnings flow. Use of beneficial tax attributes, for example, the foreign tax credits and NOLs, net operating losses, can operate to reduce the tax burden as well. We here at Mazars, we've been working on computing and reviewing many of the calculations for our clients with our own proprietary tools. And I think it's critical to point out there's already been guidance released clarifying the operation of Section 965, and we'll take a closer look at that in some of the slides below as well. In thinking holistically, though, about the impact of 965, I come back to the original question that I posed, and that is whether we really achieved what we set out to do. So did more offshore funds really come back on shore to U.S. soil today, now that we've had some time to digest and work through 965 and have some payments in and arguably maybe repatriate some of that cash home? And if yes, if your answer to that question is yes, then I'd ask you, did we pump those monies back into the U.S. economy? Or arguably, did it just all go back to the deep pockets of the owners and investors of those companies? Steve, what are some of your thoughts around the 965 tax and where we are today?
Yeah, so 965 tax is, I've seen it, from a M&A perspective. I have a client that I've seen a situation whereby a purchaser bought the stock of a company that owned CFCs, you know, and the effective date of that purchase was November 1st of 2017. And so now, you know, and the purchaser is now on the hook for the repatriation tax of the accumulated E&P of the CFCs. So this is something that, you know, November 1st, we didn't know that this was going to pass December 22nd of 17. And so now, you know, these guys are on the hook, you know, absent any you know, indemnification clause within the stock purchase agreement. So that, you know, from like I said, from an M&A perspective, that's something that I've seen a couple of times already. Jay, you have comments?
Yeah, you know what? I totally agree with you guys. As the practical matters, an accurate and updated accounting of the U.S. tax attribute of foreign subs, including EMP, tax bases, and FTC pools, will be needed to accurately compute the transaction tax. Steve, can we look at the next slides? Yeah, this slide shows a flowchart detailing the step to compute this repatriation tax. Let me walk you through really quick about this slides. The first one, am I a U.S. shareholder? If your answer is yes, you move on. Do I own interest in a SFC? If your answer is yes, continue to determine your EMP. Then allocate your deficit if you have any, and determine the cash position as the example pointed out by Tiffany, and also the calculated EMP participation exemption. Then decide to calculate, you know, the FTC disallowance, and then in the end compute tax due / your FTC offset. And next slide, let's go back to Tiffany and see what are we seeing in practice.
So we've had a little bit of time to get our feet wet, if you will, in just working through several 965 computations and selecting just a few bullets to highlight here what we're seeing in practice. Let's start with the actual E&P study itself. Here we see some clients that really have comfort in the accumulated E&P numbers that may be reported on the Schedule J of a Form 5471. That's the informational return for a controlled foreign corporation that is filed with your federal income tax return here in the U.S. annually. I think where there is lack of comfort with these numbers on a 5471, or perhaps if no 5471 is required to be filed for a foreign corporation or a specified foreign corporation, then here's where the E&P study really becomes necessary. And also, here's where you want to get a little more granular and really look to refine the E&P amount for the specified foreign corporation. The goal is to get it as accurate as possible, right? Because this is the amount that ultimately will be subject to the 965 tax, again, at either the 15.5 or 8% rate. So really understanding reserve adjustments, allowance for bad debt, transactional adjustments, tax pools, etc. All those Section 964 E&P elements, they're key in determining or arriving at the right E&P amount here. And also, I think it's important to point out here that doing an E&P study, it could take some time. So really baking that into that time element into your computation is key from a planning perspective as well, depending upon how many years you'd have to go back to do that refinement. Also, how much of that E&P, once calculated, is then allocated to cash versus non-cash? And cash is defined in the guidance as not just actual cash, right? But these cash-like items, which oftentimes can differ in the insurance space from other business models and industries. And Steve is going to talk more about this, or to this point, shortly. questions also arise as to whether funds actually have to be repatriated at the time the tax is paid, and the answer here is no. You can certainly bring the funds home at a later point in the future. And so, funds can certainly sit and bake in a foreign corporation, and once you're ready to bring the funds home, then the distribution would be treated as previously taxed income or PTI, and no further tax due since it was already paid under the toll charge. I think in assessing when to bring the funds home, one should really analyze the cash needs, both here in the US and also abroad. Maybe it's a situation where you want money in the US to reinvest, acquire, or further expand the existing domestic business, or maybe vice versa, you want the money offshore to facilitate your offshore needs and goals there. Another key element to think through is the state and local tax treatment of the Section 965 tax, and that's been an interesting and ongoing development as the various states are rising to the occasion to take differing positions on the allowance of certain federal statutory elections and deferral, for example, of the actual tax payment. Steve and Jay, what are you seeing in practice with respect to 965?
Yeah, Tiffany, I just have a question for you. So you were talking about whether the companies need to bring some of the fund home and analyze their cash needs. What have you seen so far in practice as far as any of your clients that, are they bringing the cash back home and reinvesting in the U.S. or you have yet to see that?
So we have had some clients that are bringing the cash home. In terms of actual reinvestment, we've seen a little less of reinvestment into the existing business. We have seen reinvestment into new business ventures, and we've also seen a return of the monies to the ultimate owners of the companies as well. Here, what I will say is those that are not bringing the cash back right now, it very much is a wait and see, and it's also a comparative analysis for them in terms of what their non-U.S. needs really are. So maybe there's a focus on growing more globally and enhancing their international footprint as opposed to focusing more domestically. So I guess the short answer to your question is we've seen a little bit of both. It's very facts and circumstances dependent on the client's situation.
All right, thank you for sharing that. As far as the cash, when Tiffany was talking about cash versus non-cash items on the balance sheet, when we're talking about cash positions are defined as cash, obviously held by the foreign corporation. Net receivables, again, that's net. And then also the fair market value of personal property, which would be actively traded and for which there is an established financial market, i.e. commercial paper, foreign currency, CDs, securities of federal governments, and of any state or foreign governments, and really all short-term investments. So that that goes with that, the definition of cash. As far as the federal statutory elections, this includes reference to the taxpayer's election to pay the toll charge over an 8-year period. So in other words, we're gonna, the government's or the U.S. is saying, yeah, we're gonna hit you with this toll charge for any accumulated earnings and profits that are out there. We're gonna, albeit a reduced rate, but we're gonna allow you to take that tax in or pay that tax, I should say, over an 8-year period. Jay, do you have any comments on this slide?
No, I think you have, you and Tiffany shared enough thought on this. Let's move on to participation exemption.
Okay.
And now that we've covered off the transition rule query, what happens moving into a new year starting January 1, 2018? And I think that's really what this quasi-territorial system arguably is all about. So how will new earnings be treated once repatriated into the U.S.? And remember, we've already taxed the existing offshore earnings leading up to this point through the December 31st, 2017 date. Today, any new earnings from a foreign corporation, to the extent that they're received by a U.S. corporate shareholder, will get the benefit of a dividends received deduction, or a DRD, under the new code section 245 Cap A. And this really is quite a nice benefit if you're a domestic corporate entity. The foreign portion of any distributed dividends are no longer subject to U.S. tax, so hence the territorial taxation by nature, provided they're not from a foreign corporation that's PFIC, that's a hybrid entity, or related to Subpart F or GILTI. I think also the new code section requires U.S. corporate owners to hold an interest in the foreign corporation for a minimum 1-year time period. So there is a holding period attached to this. And again, this tax break only applies to distributions that are made post the December 31st, 2017 date. So now you're probably scratching your head and maybe asking, well, what if I'm not a U.S. corporate owner of a foreign corporation that's repatriating funds to the U.S.? And if that's the case, well, then you fall into the old rules with, we'll call it a bit of refreshment. So the income would likely be subject to the new U.S. tax rates accordingly. So depending upon your legal entity classification or individual classification, and may be subject to arguably some supplemental tax under the Subpart F regime, or even GILTI. And the additional tax analyses that would need to be performed on your specific facts and circumstances are what would get you to the right answer in this case. So consider the impact, especially here, of a hike in your rate due to any of the state and local impact on these types of distributions as well. I think here's where the modeling and the tax impact, let's say corporate versus flow through, becomes really important in terms of understanding the tax consequences under any scenario. Also in practice, I would say our clients are certainly keeping us busy here, because we're analyzing many iterations of structures to really understand and quantify these tax considerations. Some of the arrangements in the insurance space, for example, where you might wish to ensure your DRD status, really include those situations where you might have a U.S. owner owning a foreign corporation like an offshore reinsurance company, which prior to TCJA was subject to tax deferral. Now you still want to run your models to ensure that your structure or your arrangement certainly qualifies for the DRD, and if it doesn't, think through ways to restructure such that it is tax optimal and efficient. Steve, what are some of your assessments here?
Yeah, so there's so many moving parts of this, and on your last piece there about the offshore reinsurance company, you want to take dividends 100% tax free. However, because there's so many moving parts and interactions of the old and new international rules, that can affect and subject unwary taxpayers to the other international provisions. For example, your example of the offshore reinsurance company, while you'd be able to have a 100% DRD, can lead to B tax if they're a foreign reinsurance affiliate, and using that affiliate to run reinsurance through it, and so that could lead to a B tax, which we're going to discuss a little bit later on. We'll also discuss some PFIC rules later. Jay, any comments on this slide?
Yeah, no, nothing much to add. Let's look at the GILTI. The next slides talk about another subchapter F, income taxes.
Okay.
So here, focusing on the main international provisions and really moving into, again, continuing the discussion around this quasi-territorial or hybrid taxation system, we'll get started with GILTI. And GILTI stands for Global Intangible Low Tax Income. And you might think, okay, well, why do I care about this, right? If I'm an insurance company, I've got an active insurance business, I have no, bank of intangibles that's sitting in low taxing jurisdictions. I'm not this tech or service company with, again, a boatload of intangibles and little by way of tangible assets, risks, functions, assets sitting in these low tax jurisdictions, and add on to that or layer onto that rulings that award you next to nil taxation. Well, here's where we say just think again, because the GILTI regime certainly has many unintended casualties, like companies in the insurance space. So essentially the GILTI tax, it acts as another class of subpart F income that impacts all U.S. shareholders of controlled foreign corporations. It essentially assumes a certain return, 10% on a company's QBI or qualified business asset investment. This would be your quarterly average tax basis of your depreciable property or your tangible assets. And any tested income that is in excess of this 10% statutory return essentially is deemed to be related to GILTI, and it's subject to taxation whether it's repatriated to the U.S. shareholder or not. So in essence, just like subpart F. Now, of course, it's subject to tax at the new U.S. tax rates. However, here's another example where we see a bit of a perk or bonus for U.S. corporate owners, because the U.S. corporate owners get a bit of a tax break and they're entitled to a statutory deduction of 50% of their GILTI income. So in essence, instead of paying tax at a 21% rate on their GILTI net tested income, a U.S. corporate shareholder pays tax at a reduced rate of 10.5. You might think, why is all the good treatment going to the U.S. corporate owners as opposed to, let's say, an individual or some other owner of through a flow-through entity? But here, there is an ability to make a special election to be treated as a corporate shareholder under 962 of the code. It doesn't just apply for GILTI, it applies for other international provisions as well. And it's certainly something to think through and model to see if, again, the tax effect makes sense for your specific facts and circumstances. It would not only afford you, in this case, for GILTI, the benefit of the 50% deduction to get to the 10.5% rate. But remember, it's the corporates that are permitted to take foreign tax credits. So here, doing something like a 962 election would allow the corporate owner a limited deemed paid credit, not in full, 100%, but 80% of the foreign taxes that would be attributable to the GILTI tested income as well. Steve, what have you seen here?
Yeah, I mean, I'll be honest, I haven't seen too much here. I mean, but this GILTI provision, when they were going through the scoring of the various proposals out there, this really increased revenues, as you can see there, by 112 billion over the 10 years. So I'll have a comment on that, and then Jay, I believe you have something to add.
Yeah, for certain group, there may be advantage to restructuring in a manner that causes high tax foreign income to be treated as subpart F income rather than GILTI. For example, we could while reinsurance to fill the home country risk requirement in Section 953E as ability to offset inclusion with foreign tax credit, maybe more straightforward, and the credit may be carried forward, unlike the GILTI credit. So next slide, let's see, Tiffany, what are you seeing in practice for GILTI?
So as we're preparing the models and reviewing calculations for the GILTI tax, we noted a few of the things that are listed here. I think one item to note is just overall CFC or CFC status. So given the change in the definition for what it really means to be a CFC, some entities in the insurance space, which may have had, let's say, a limited vote power due to vote cutbacks, now are pulled back into the CFC net by value. We'll touch upon the new CFC definition and some of the other international tax provision slides later on. But this would certainly increase the population of insurance companies that are subject to GILTI analysis, and that's just one example. There are many others. It's also significant to understand the ins and outs regarding the definition of tested income and the operation of related expense allocation that could reduce the amount. Noting that tested income does not exclude subpart F income, the high tax exception, effectively connected income, or certain related party dividends, etc. Does not include those items. That's important to remember as you're going through the calculation, and we've done some calculations where that's been forgotten. Also, in making a Section 962 election to be treated as a corporation, does the benefit obtained under GILTI really outweigh the cost to repatriate money outside of the corporate status, if you will? So really, thinking through, as I mentioned in the slide before, wanting to obtain some of that corporate benefit, that reduction in rate to the 10.5 and being able to take advantage of an FTC, let's just say when you do look to repatriate the funds from that U.S. corporate entity, what's the tax that then the owners would suffer? And so layer that onto your GILTI tax. Does it still make sense to make that election? Steve, what other considerations would you add here that you've seen in practice?
Yeah, I mean, actually, I'm working with a few clients here, and we're still trying to work through some of the definitions here, and trying to figure out exactly what we're, whether they're subject to these rules or not. Jay, anything you've seen or?
Yeah, there's not much I could add. Tiffany and Steve have very good insight in this, the GILTI. I mean, let's move on to another topic of BEAT.
Yeah, so the BEAT tax here, I'll say that we've all seen a lot of work in this area over the last few months, trying to get our global clients with reinsurance companies, specifically foreign affiliated reinsurance companies. This is a huge thing, and we've been working with clients, working through the models and the definitions within the provisions. I'll leave it. I'll have Tiffany share with you her ideas on BEAT.
Thanks, Steve. So BEAT, or the Base Erosion and Anti-Abuse Tax, it essentially is the new alternative minimum tax for global income. And this tax is only applicable for U.S. and foreign corporations that essentially have large gross receipts and also a certain level of what's called base erosion payments. So the first part of the tax requires gross receipts of $500 million or more over an average 3-year period. So if you meet this test, this gross receipts test, then you move on for further BEAT tax review. If you fail this part of the test, then lucky you, you can stop there and no further analysis. I think the next part of the test analyzes your base eroding payments. So if they meet or exceed 3%, or 2% in the case of financial services companies, then again, you continue along in the BEAT analyses or review. And if you fail this test, then again, that's good news for you because you don't have to move further. So one thing is for sure with respect to your company is before getting excited about BEAT, just make sure that you meet the definitional or threshold requirements of those first two tests, because oftentimes you can get out quickly there. The base eroding payments that we would then look at after concluding we've met those two tests are these payments that are made from the US and they're paid to foreign related parties, okay? And it's not every single payment. So these payments don't include things like derivative payments, payments that would otherwise be classified as COGS or cost of goods sold. And they also don't include certain cost service payments under the 482 transfer pricing regulations. They do, however, include the usual type of your, passive related party payments that typically are used to strip earnings tax-free or tax efficiently from the U.S., things like interest, rents, royalties, management fees, etc. And the base erosion percentage is determined as your base eroding deductions, so those payments that we just described, over your overall total deductions. So again, to the extent that you run the math and the result is 3% or more, then you'll likely be subject to BEAT. And the BEAT tax itself is codified in the new section 59A of the code, and it then requires, again, once you pass the gross receipts test, once you pass the base erosion percentage test, then you recompute your taxable income. And this is a new taxable income. It's known as modified taxable income. And you would compare that modified taxable income, or MTI, to your regular taxable income. So if your modified taxable income, essentially, and that is your regular taxable income with add backs for the benefits you receive for those base eroding payments, so we're not going to give you the benefit of deducting them. You would then take 5% of that MTI, or your modified taxable income, today. The percentage changes in years later. It's a phase-in approach, so it's 5% today, it's 10%, and ultimately 12.5% in later years. And then you subtract from that your regular tax liability. And essentially what remains is your BEAT tax. So in essence, the new code section 59A says that if you base erode the U.S. too much, then you will be subject to a minimum tax in the U.S. And this is certainly no different than what we're seeing in the tax community today, especially with respect to BEPS, the base erosion and profit shifting proposals, where many countries around the globe, they've already started enacting base erosion laws. And arguably, some have said and still could say the U.S. is a little late to the party by enacting this BEAT legislation. But despite perhaps being, late to react, the U.S. Certainly has caused an uproar with this BEAT tax because many in the tax community, many of our treaty partners, many of the finance ministers are on record saying they're furious because BEAT essentially violates many of our trade agreements, our treaties, and encourages double, maybe arguably triple taxation. And we all know where we are today from a trade perspective and the commentary that we're hearing in the tax community around that. Steve and Jay, I'll turn it over to you for some further thoughts there.
Sure. Although the BEAT tax is labeled as a minimum tax, the tax paid is not creditable, as was the prior AMT, alternative minimum tax. And so what happens there is this becomes a permanent tax. And once it's paid, there's no offsetting credit in the future. So that's hypercritical in understanding that, so that you either plan to greatly reduce your BEAT or avoid it altogether. And we'll talk about some of the things that we've seen in practice to try to get not around BEAT, but just trying to restructuring the operations in order to not be subject to BEAT. And so, yeah, I'd like to talk a little bit about the consolidated groups as they relate to BEAT. There is a strong argument that consolidated groups are treated as one taxpayer for purposes of applying the BEAT. That is, after applying the aggregation rules to determine which taxpayers are potentially subject to the BEAT, right? In other words, full control group is tested to see whether all members will be applicable taxpayers. After that, it appears that all members of the consolidated group are treated as one taxpayer for purposes of calculating the BEAT liability. And the BEAT liability appears to be calculated on an entity by entity basis for a control group, for each control group members that are not members of the consolidated group. All right, so consideration should be given to the applicability of BEAT to the tax sharing agreements. And from a tax standpoint, so again, I've seen in practice tax sharing agreements that consider, the prior AMT calculations. And since this is a minimum tax as well, there should be some consideration within the tax sharing agreements for some revisions in order to determine, how best to allocate the BEAT tax. So yeah, we're gonna share. If you don't have any other items, I'm gonna continue on here, and we'll see what we have. Some things that we're seeing in practice. And Tiffany, you could start us off, and then I'll jump in for some of the things that I've seen in practice today.
Sure, sounds good. I think in practice, and this is the right time, we were seeing some estimates that were being calculated at year end, and now that we're, half year essentially into 2018, we're refining some of those estimates that we had seen earlier on at year end. And I'm sure many have seen the footnotes, if you will, to the financial statements. Many of companies saying they had yet to assess the impact of BEAT and GILTI, but now at this time, assessment is possible. So here in practice, in looking at many of the calculations, a few bullets here that really resonate with me are: one, just make sure you watch out for some of the basic traps like double counting of income. And as you're working through some of the models, and we've seen many models produced by many companies, and we have our own proprietary models that we work with here inside Mazars. But again, watching out for the basic trap of double counting is key, and that can happen with respect to formulas. We've seen instances of double counting with figures related to interest, for example, the impact of 163J and disallowance of interest with respect to taxable income, and again, maybe being adjusted for MTI purposes or modified taxable income purposes. Add backs for subpart F and GILTI are required unless you're meeting the high tax exception. There are no carve outs for the items just yet. With those items, at least with respect to computing MTI, maybe we'll see something different when the proposed regulations come out later in the year. Also, depreciation and amortization adjustments, they are required to arrive at MTI, but they're only required to the extent that they're related to property acquisitions that are from foreign related parties, and they have to be acquired post December 31st, 2017. So again, double and triple checking those numbers is recommended. Best practice also is to just inventory all your base eroding payments and really make a list of your rationale for why you're including them or why you're excluding them as you're computing your MTI. So for example, if you have a cost and you think I'm going to exclude it, why are you going to exclude it? You're going to exclude it because you're classifying it as part of COGS or cost of goods sold. Notate that. Maybe a payment is excluded because it is accepted under 482. It's a service cost relief. Again, notating that and what's your rationale, and that way when your audit teams are reviewing it, you can review it and exercise a bit of professional skepticism and say this rationale is sound, it makes sense, it's reasonable. Again, just encouraging you to review those methodologies, as well as the methodologies that you're using for annualizing any numbers. So, at this time, as we're looking forward to, year end and estimated payments are being made, you're making those payments based upon annualized figures. So what's your methodology, again, and rationale for your annualization? Sometimes we've seen simple methodologies. It's just taking a quarterly estimate or quarterly amount and saying, oh, I'm going to multiply it by 4. But is that really right for your business? Or are you more of a seasonal business? Do you see more of an uptick at the latter half of the year or more of an uptick at Q2? So really thinking through those rationales to really refine your final number is key. And that's not only applicable in the case of BEAT, but it's applicable as you're working through GILTI as well. Steve?
Yeah, thank you. Thank you for that. So, on the bullets that we see on the slide, there's a question about inbound, outbound payments. There's no provisions, within the rules that allow for the netting at this time. Reinsurance premiums cannot be, right now, the industry is, right now is not netting against ceding commissions or claims. And so what that means is that even for U.S. domestic reinsurers reinsuring foreign risks and receiving premiums, right? So not premiums going offshore necessarily, but actually the reverse, where the foreign insurer is reinsuring to a U.S. company, to a U.S. reinsurer. The resulting claim payments and ceding commissions to the foreign insurer, need to be considered under the BEAT provisions. In other words, those are payments that are going from the U.S., out to a foreign offshore company. And so, that seems really harsh, and is probably an unintended consequence of these rules. But nonetheless, right now, you need to consider those claim payments going off to a foreign affiliate, as well as the ceding commissions. So the claim payments can arguably be treated as offsets to gross income, not specifically referenced under Section 59A, and therefore, not considered base erosion payments, essentially being part of the cost of goods sold, akin to the cost of goods sold. Unfortunately, there's no similar statutory argument that applies to the life companies for reinsurance. For the insurance space, we are seeing global groups of companies electing Section 953D for the offshore reinsurers. So Section 953D is an election that is made by the offshore reinsurer to be treated as a U.S. domestic taxpayer. So think about what that means is, that you're no longer, as long as that offshore reinsurance company is electing a 953D, they're no longer considered a foreign affiliate and would be considered a U.S. taxpayer that, number one, would be included in the consolidated domestic return, but then not subject to BEAT because those reinsurance premiums are going to essentially what is another U.S. domestic taxpayer. That election also has the benefit of not subjecting the premiums that are going offshore to the excise tax under Section 4371, which is imposed on each policy of insurance, indemnity bond, annuity contract, or reinsurance policy issued by a foreign reinsurer. Also, we've seen, for the service cost method rule, we've seen companies restructuring their intercompany agreements with the foreign affiliates. As I mentioned earlier, with regards to the consolidated groups, consideration has to be given to the applicability of the BEAT and tax sharing agreements. So we have a couple of actually some simple examples here. One is an example of a profitable year. And
Steve, if I could just remind you, we have 5 minutes left. So if we want to get through all your main points that you got left, I know we got a few good slides left here, but we're coming up to close the hour here.
Sure. So what I'll do is I'll just say that these examples are here. They're obviously very simple examples, but what they do is they illustrate the fact that how the BEAT works. And I'll say that example 2. Here's a loss year, and the takeaway from this slide is the fact that they may be in a loss year, but they're actually going to have a tax that they're going to have to pay. So just some things to note there. Now we want to move on to some other provisions. And so, you know what, I think
let me touch on the one topic real quick. The repeal of Section 958(b)(4) construction ownership rule under this code section. All category of U.S. shareholders should review their investment in foreign corporation this year and determine if their foreign corporation should be classified as CFC. That's the only point I want on bringing up for this slide.
Okay. All right. I'll just add a little quick thing here about the PFIC rules. The PFIC rules have changed, and what's considered a qualified insurance company has changed, where the insurance liabilities need to be in excess of 25% of the total assets of the as reported on the foreign corporations applicable financial statements. Tiffany, do you have anything that you want to wrap up with?
I think we've covered the main points. I would just say the slide that's showing here, the third bullet point, downward attribution, that's new, pay attention to it. Essentially, foreign companies that have U.S. subsidiaries, those U.S. subsidiaries could pull you into CFC status. Again, reviewing the definition of a U.S. shareholder under 951(b), no longer is it just 10% of vote, but now includes value as well. So that again widens the population for CFC status. And again, that elimination of the 30-day period or holding day period is key too for Subpart F inclusion purposes. And we know for in insurance, the Subpart F rules are a bit different than the norm for other industries. And you've covered the PFIC rules, which I think is the important one there for those on the call in the insurance space.
I think I didn't see any questions come up during our presentation. I appreciate everybody's time. And if you do have questions, you have I believe you have our contact information. Vaughn, do you want to wrap this up?
Yeah, on behalf of PAMIC, I want to thank everyone for attending today's webinar. We hope that you found this presentation valuable. I know that they went through some great examples, and if you guys want to find their contact information after we're done here, it'll be posted on our website and you'll receive an email with that information. We just want to remind you that we have another webinar coming up. It's going to be on July 26th, and it's going to be the future of insurance law, restatement of law liability insurance. That's going to be hosted by Scott Ribney of Rebar Burnsteel and Richard DeBella of DeBella Greer, McAllister and Best. And so you can visit our website to find more information on that webinar or to register. But we really appreciate you guys coming out here today and listening to our presentation. And we want to thank our sponsors again. So thanks everybody for watching the webinar. And if you need to watch this later, feel free to watch it on our website. Thank you.